we've seen almost a full market cycle in almost 4 months when it comes to certain strategies. So what I'd like to do this month is, well, what I always do. We'll talk about the macros. I think the backdrop is very important, and we do have a point of view. So we'll start with a policy backdrop. Then we'll talk about economic indicators. Then we'll talk about market signals, market indicators, and what we believe the outlook is for the economy and the markets. Okay, so on the fiscal policy front, well, the stimulus, the first part of it is in place. We're seeing it come through the economic statistics as well. And it does look like we're going to get somewhat of an infrastructure bill, which may include tax increases, but I think the odds there are going down. The closer we get to the midterm elections, given how razor thin the margins are in both the House of Representatives and the Senate, the lower the likelihood of significant tax measures. Nonetheless, we did get the proposal, the tax proposal. It includes an increase in the capital gains tax rate, the top rate, the very top rate, going to 43.4%. And I believe right now that's 22.8%, so quite a big jump. And because of that proposal, I think we've seen a lot of the high-flying stocks, the ones with very significant gains during the past year and a half, those I believe were hit hard because of that proposal. Rarely is the capital gains tax rate put in place, or a change put in place retroactively. So I do think investors jumped the gun on that one, understandably. I doubt we're going to see anything near that rate. And in fact, I am wondering if we're going to see much in the way of tax increases, as I just mentioned. We know that the corporate tax rate will probably not go from 21 to 28%. Perhaps it will go to 25%. That seems to be the compromise brewing. And the top tax rate for high income earners going back to 41.8%, perhaps that goes through. The capital gains tax rate, I'm very doubtful. Now, on monetary policy, the M2 growth rate on a year-over-year basis is 24.2. I think it peaked out at 27%, so the deceleration has begun, but that is still a very rapid rate by historical standards. And because of it, and because the Fed is saying it will continue to err on the side of ease until inflation is above 2% for a sustained period of time. So again, the markets are not expecting much in the way of Fed tightening before late 2022 or early 2023. Now, we could be surprised. There are some inflation gauges that are picking up some steam. But so far so good. The bond market is not following through on the big sell-off it had in the first quarter, and we'll talk a bit about that in a moment. The Fed does continue to talk about the base effect, so the impact of the collapse in commodity prices last year, commodity and other prices last year during the depths of the coronavirus, and the comparisons we're facing now. So oil dropped, I believe, below $30 for a moment in time back then. And now it is over $60, so more than a doubling in a very important price. And it does seem, according to the University of Michigan, that inflation expectations have picked up a bit. when looking at a 1-year time frame, but looking at a 5 to 10 year time frame, inflation expectations are still in the 2.5%, maybe a little north of that percent range. I have been surprised that some of the commodity prices are spiking and breaking out of very, very, very long-term bases, and I'll go into that in a moment. It certainly has my attention, and I know anyone who's been building a house or renovating knows that lumber prices have tripled, I think, in the last 6 to 9 months, quite dramatically. On the economic indicator front, now we still believe we're in a V-shaped recovery, and that there will be nothing getting in the way in the short term. In fact, businesses continue to scramble. They cannot keep up with what's going on out there. Now, you wouldn't know that from the employment report we just got today. The employment report was quite weak relative to expectations. So an increase of 266,000 in non-farm employment. The expectation was close to 1 million, an increase of 1 million. And if you take the downward revisions, the net employment increase was closer to only 188,000. So what is going on if businesses are scrambling and can't meet demand? What is going on is if you pay people not to work, they won't work. And I think a lot of companies are having trouble finding help. And in fact, one of the important clues of that is, and I've never seen anything like this, is temporary employment dropped 111,000 in 1 month. What does that tell us? It tells us, though, that those companies who have hired temps and realize they cannot find employees on a permanent basis, they are luring the temporary employment, the people who are working for them temporarily, they're luring them in probably with some pretty good packages. And what we saw in average hourly earnings would confirm that. Leisure and hospitality is picking up dramatically now. I think the number was close to 350,000 increase in that employment level. Those wages, the wages for that category of employment, are much lower than average.